Welcome to Save Simple Sound Podcast. I'm your host, PK. Today, we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please remember this podcast is for educational purposes only. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Now, let's get started.
Imagine if you could build an investment portfolio that could weather any market storm, preserving your wealth while generating consistent income. Today, we're diving deep into the art and science of bond portfolio construction.
Wait, bonds sound boring. Why should anyone care about this? Most people think bonds are just for retirees, right?
Actually, bond portfolios are like financial shock absorbers. In volatile markets, they're not just important, they're essential. What most people don't realize is that strategic bond investing can dramatically reduce portfolio risk while creating predictable income streams.
Thanks for that vivid analogy about bond portfolios as financial shock absorbers. It really drives home why this matters to all investors, not just retirees. So, Sam, could you walk us through the fundamental building blocks of a well-constructed bond portfolio?
Absolutely. At the core of any sophisticated bond portfolio, you'll typically find a foundation of high-quality holdings like U.S. Treasuries, investment-grade corporate bonds, agency mortgage-backed securities, and for some investors, municipal bonds. Treasuries provide the bedrock of safety and liquidity. Investment-grade corporates offer some yield enhancement while maintaining solid credit quality. Agency MBS contribute diversification and usually higher yields than treasuries alone, and munis can provide tax-advantaged income for certain investors.
Okay, so it's about building a solid core. But how do you decide on the right mix of these different sectors?
Great question. This is where the art of diversification comes in. By carefully allocating across these sectors, you can target your desired blend of stability, income, and risk management that aligns with your specific goals. The key is to understand the unique characteristics of each sector and how they interact. For example, treasuries tend to be the most sensitive to interest rate movements, while certain corporates and MBS can provide some cushion. Munis may react differently to market stresses than taxable bonds. So the right mix allows you to balance and offset different risks.
So if I'm hearing you right, Sam, sector diversification is really about making sure not all your eggs are in one basket, so to speak, spreading out risks in a purposeful way.
Precisely. It operates on the same fundamental principle as diversifying a stock portfolio across sectors. You're never too reliant on any one area of the market. Of course, the exact recipe depends on each investor's unique objectives and constraints. A growth-oriented investor will likely have a different mix than someone primarily concerned with capital preservation, for instance.
That makes sense, but I imagine getting that balance right is easier said than done, especially in complex market conditions. How do you approach the construction process?
It definitely requires careful analysis and stress testing. We'll often model out different allocation scenarios to see how they might perform in various market environments: rising rates, widening credit spreads, flights to quality, etc. A thoughtful sector allocation provides a solid foundation, but it's also dynamic. It has to adapt as markets and goals evolve. So ongoing monitoring and rebalancing is crucial.
I love how you broke that down, Sam. It really illustrates how bond portfolio construction is this blend of structural elements and responsive management. So far, we discussed the importance of sector diversification in bond portfolios. Sam, you mentioned that a thoughtful allocation across treasuries, corporates, mortgage-backed securities, and munis can help balance risks. But I know many investors also use specific portfolio construction techniques to further manage risk and returns. Two common ones are laddering and barbells. Could you break those down for us?
Absolutely. Let's start with laddering, which is a time-tested approach that can help manage interest rate risk. The basic idea is to build a portfolio with bonds maturing at regular intervals, like the rungs of a ladder. So, for example, you might divide your portfolio into equal parts maturing in 1, 2, 3, 4, and 5 years. As each rung matures, you reinvest the proceeds into a new 5-year bond, maintaining that laddered structure.
Okay, I think I get the concept. But what's the benefit of structuring it that way?
Great question. The ladder strategy helps in a few key ways. First, it provides a steady stream of income, since you have bonds maturing and paying out regularly. Second, it manages interest rate risk by allowing you to reinvest a portion of your portfolio each year. If rates rise, you can reinvest the maturing bonds at higher yields. If rates fall, you still have higher yielding rungs locked in. So it balances out some of that rate sensitivity.
That's a really clear explanation, Sam. So, in a way, laddering helps smooth out the impact of rate fluctuations over time.
Exactly. It's not a total shield against rate risk, but it definitely helps create a more all-weather portfolio.
That makes sense. Now, what about barbells? I've heard that term, but I'm not sure how it differs from laddering.
Right. So a barbell strategy takes a somewhat different approach. Instead of spreading out evenly across maturities, you concentrate your holdings in two distinct maturity ranges, typically short-term and long-term bonds, with less in the middle. Visually, it resembles a barbell with weights on each end. The short-term portion provides liquidity and stability, while the long-term bonds offer higher yield potential. Barbells tend to be more responsive to shifts in the yield curve than ladders.
So, it's a way to balance some of the trade offs between short and long maturities, the stability of short term bonds and the income potential of long term ones.
Precisely. The exact mix depends on your objectives and outlook, but that's the general principle. In steeper yield curve environments, barbells can be particularly effective at capturing that term premium.
Okay, so both ladders and barbells are ways to structure maturities in a purposeful way. Ladders spread out evenly for steady income and rate risk management, while barbells concentrate on the short and long end to balance risk and return.
You've got it. Of course, these are just two tools in the broader bond portfolio construction toolbox. The key is to align your strategy with your specific goals and constraints.
This has been such an enlightening discussion, Sam. I love how you've made these concepts so relatable. What are few key takeaways on putting this all together? Combining sector allocation with strategies like laddering and barbells.
I think the main points to remember are 1. Start with a solid core of high-quality, diversified sectors. This is your portfolio's foundation. 2. Consider strategies like laddering or barbells to structure your maturities in line with your objectives. 3. Regularly monitor and rebalance your portfolio as markets and your needs evolve. This is an ongoing process. 4. Don't be afraid to seek professional guidance, especially as your situation grows more complex.
Those are great points to keep in mind. It really underscores how bond portfolio construction is this dynamic process of balancing different elements to achieve an overall goal.
But Sam, I'm curious, how do you see these approaches fitting into the broader portfolio construction process?
That's a great question. Laddering and barbells are really techniques for managing maturity and duration risk within a bond allocation, but they should be implemented in the context of a thoughtful, overall portfolio structure. The starting point is always defining your objectives and constraints, your return targets, risk tolerance, liquidity needs, time horizon, tax situation, and so on. That foundation guides your high-level allocation across stocks, bonds, and other assets. Within the bond sleeve, sector diversification is the next key step. As we discussed earlier, a mix of treasuries, corporates, MBS, and munis can provide important diversification benefits. Laddering or barbells then help you further tailor your bond portfolio's risk and return profile.
So if I'm understanding correctly, the portfolio construction process kind of follows this order. Establish investment objectives, set asset allocation, diversify bond sectors, then implement specific maturity strategies. Is that right?
Exactly. And it's important to remember that it's not just a one-time process. As your circumstances and market conditions change, your portfolio will likely need to adapt as well. Regular rebalancing and adjustment are crucial.
That's such an important point, Sam. I think many investors set their initial allocations and then put things on autopilot. But as you note, ongoing management is essential, especially in the bond markets, which can be so dynamic.
Absolutely. Take the current environment, for instance. With interest rates rising, many bond investors are having to rethink their duration positioning and sector tilts. Those who are actively managing may be shortening duration or shifting allocations to sectors like floating rate notes that can be more resilient in rising rate periods.
That's a good reminder of how crucial it is to stay engaged with your portfolio. It sounds like even if you have a solid structure in place, you need to be prepared to make tactical shifts as conditions evolve.
Well said. I often compare it to the maintenance of a house. You need a strong, well-designed foundation, but you also need to be prepared to make repairs and updates over time to keep things in top shape.
I love that analogy, Sam. Just like a home, a bond portfolio requires that upfront thoughtfulness and that ongoing care to serve you well in the long run. What would you say are the key takeaways for our listeners looking to build and manage stronger bond portfolios?
I think there are three main points I hope everyone takes away. 1. Start with a clear understanding of your objectives and constraints. That's your guidepost for every decision that follows. 2. Construct your portfolio in layers. Begin with your high-level asset allocation, then build out your bond portfolio with sector diversification and targeted maturity strategies like laddering or barbells. 3. Review and adapt your approach over time. As market conditions and your own circumstances evolve, your portfolio will likely need to evolve as well. Embrace active management.
Fantastic insights as always, Sam. Thank you for breaking down these complex concepts and giving our listeners such actionable guidance. Sam, could you expand on how this sector diversification helps manage risk in a bond portfolio?
Absolutely. Each of these sectors has unique risk and return characteristics that can complement each other in a portfolio. Treasuries, for instance, provide the bedrock of stability and liquidity. Corporates offer the potential for higher yields, but with incrementally more credit risk. MBS provide diversification and often higher yields than treasuries, but with some prepayment risk. And munis can offer tax-advantaged income for those in higher tax brackets. By spreading holdings across these sectors, investors can mitigate the impact of adverse developments in any single area. It's a way of ensuring you don't have all your eggs in one basket.
That makes sense. So if yields spike in one sector, or if there are credit concerns in another, the other holdings can provide some ballast for the overall portfolio.
Precisely. Of course, diversification doesn't eliminate risk entirely. In times of broad market stress, correlations often rise and all sectors may experience challenges. But a well-diversified structure can definitely help smooth the ride for investors.
That's a crucial point. Diversification is a risk management tool, not a magic bullet. But used properly, it remains one of the most powerful techniques for fortifying a portfolio. Sam, once an investor has built out this diversified core, what are some next-level strategies they can consider to further optimize their bond holdings?
Once the core is in place, investors can consider more targeted strategies to fine-tune their risk and return profiles. This is where approaches like laddering and barbells can come into play. With laddering, you spread out maturities evenly across a range of years. This helps manage reinvestment risk and provides predictable liquidity. Barbells, on the other hand, concentrate maturities at the short and long ends of the yield curve. This can help investors pick up incremental yield while keeping some dry powder to reinvest if rates move higher.
It's interesting how these strategies allow investors to take more nuanced positions around risks like interest rates and liquidity. But how do you decide which approach makes sense for a given situation?
Great question. It really comes back to the specific objectives and constraints of the investor. Those with steadier cash flow needs might prefer the regularity of a ladder. Those more focused on maximizing yield might lean toward a barbell. And in reality, many investors may use a combination of these approaches in different parts of their portfolio. The key is to let your big-picture goals drive the details of your implementation. There's no one-size-fits-all solution.
I think that's such an important takeaway. Effective portfolio construction is all about tailoring the building blocks to your specific needs as an investor. Sam, as we think about putting these pieces together, what role does ongoing management play? Is this a set it and forget it kind of process?
Far from it. While the initial construction is crucial, ongoing oversight is equally vital. Market conditions are constantly shifting, and your portfolio needs to adapt accordingly. This is where techniques like rebalancing come into play. By periodically resetting your holdings back to your target allocations, you help control risk and enforce a level of discipline in your portfolio. It's also important to keep a close eye on the risk and return profiles of your individual holdings. Changes in interest rates, credit quality, or market liquidity can all impact the role a given bond plays in your portfolio. Regularly revisiting your positions and making adjustments as needed is a key part of the process.
So it's really a combination of upfront strategic work and ongoing tactical adjustment. Kind of like sailing a ship, you need to plot your overall course, but then make corrections along the way as the winds change.
I love that metaphor. It captures the essence of bond portfolio management so well. You need that clear long-term vision, but also the flexibility and diligence to navigate changing conditions. What key ideas would you want our listeners to take away on this topic, Sam?
I think there are 3 central points. First, effective diversification across key bond sectors provides the essential foundation for risk management. Second, strategies like laddering and barbells allow investors to further shape their portfolio's risk and return profile. And third, ongoing oversight and adjustment are vital to keep a portfolio on track as markets evolve. The path to bond investing success is paved with intentional diversification, thoughtful customization, and diligent ongoing management.
Beautifully summarized, Sam. So the core sectors form the bedrock of a well-constructed bond portfolio. But I'm curious, once an investor has built that solid foundation, what are some additional strategies they can use to further optimize their bond holdings?
That's a great question. While sector diversification is indeed crucial, there are several other levers investors can pull to fine-tune their bond portfolios. 2 key strategies that come to mind are duration management and individual security selection. Duration, which measures a bond's sensitivity to interest rate changes, is a critical factor to consider. By actively managing the duration of their portfolio, investors can align their interest rate risk exposure with their specific investment horizon and objectives.
So if an investor is concerned about rising interest rates, they might choose to shorten their portfolio's duration to mitigate potential price declines.
Precisely. Conversely, if they expect rates to fall, extending duration could help maximize gains. Of course, this requires a view on the direction of rates, which is notoriously difficult to predict consistently. That's why many investors employ more neutral duration positioning as a risk control measure.
That's a vital point, Sam. Duration management can be a powerful tool, but it's not about taking outsized bets on interest rates. It's really about aligning your portfolio's rate sensitivity with your specific needs and risk tolerances.
Absolutely. And this ties directly into the second strategy I mentioned, individual security selection. Within each broad sector, there can be significant variation in the risk and return profiles of individual bonds. By carefully analyzing and selecting specific securities, investors can potentially enhance their risk-adjusted returns.
Interesting. So even within, say, investment-grade corporate bonds, some issuers or industries might offer better value than others at any given time.
Exactly. Factors like the issuer's financial health, their competitive positioning, and the broader industry dynamics can all impact a bond's attractiveness. Rigorous credit analysis can help uncover these opportunities.
It's almost like stock picking, but in the bond world. The key, I imagine, is to ensure that any individual bets are sized appropriately and don't undermine the overall diversification of the portfolio.
That's right. Security selection can offer incremental benefits, but it should be done within a robust risk management framework. Diversification always remains paramount.
This really underscores how multifaceted bond investing can be. It's not just about choosing broad sectors, but also actively managing key risk factors and selectively seeking value within those sectors.
I think that's a perfect summary. Building a successful bond portfolio requires a thoughtful blend of top-down sector allocation and bottom-up security selection, all within a diligent risk management construct.
Indeed. And I would add that this process is ongoing. As market conditions evolve and portfolio needs change, continuous monitoring and adjustment is crucial. Regular rebalancing to maintain target allocations, refreshing individual holdings as opportunities arise, and maintaining a forward-looking perspective are all integral to long-term success.
Fantastic. Thank you so much for breaking this down for us today. And thank you to our listeners for joining us on this journey. We'll be back next time with an in-depth look at the different sectors of the bond market, from treasuries to corporate bonds and beyond. Until then, stay curious and invested.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.